All right, beautiful summer day here. Feel like it's ticking away, but we're enjoying ourselves out here on a toasty Sunday on Cape Cod. Want to talk a little bit about the payroll number we got last week and some under the radar comments on Mary Daly that I think you should be aware of. So the number obviously came out a week on a headline basis on Friday at about 8:45. I piped into my client chat on Bloomberg and said the bond market's overreacting here because this just is not going to move the needle for the Federal Reserve. And that turned out to be accurate by the end of the day. I think the long end of the Treasury market was flat. 2-year was up a couple ticks. But the bottom line is the number, despite the weak headline, really doesn't change the labor market outlook, which I have characterized as stable at lousy levels. Basically we're creating 30,000 healthcare jobs a month, call it, and the rest of the economy is creating basically nothing. And if you look at, 3-month, 6-month, or 12-month moving averages, they all give you that same message. So the Fed has deemed the labor market box checked, and there was nothing in Friday's release that would lead them to think they need to uncheck it, particularly because the unemployment rate fell to 4.1%, and many FOMC members over years have told us that that's their catch-all indicator for the labor market, that they weight above all others. And here's the thing. Yes, the last couple months, the unemployment rate ticked down among weak household employment because the labor force participation rate has come down sharply. The Fed doesn't give a shit why the unemployment rate falls. If it falls because labor participation is falling, they're going to say, well, I guess the workforce is shrinking. And from their slack perspective, that suggests that the equilibrium level of job growth is lower. Around zero is what Richmond Fed President Barkin told us in the wake of the release on Friday. So they're fine with stable and lousy job growth because in their model, that's consistent with the shrinking labor force, as the labor force participation rate decline tells us. So they don't care why the unemployment rate fell, it just fell. Obviously, they're putting everything on the next couple CPI releases. What the Fed is telling us is that if we get as expected CPI the next couple months, they're hiking in September. And Mary Daly told us on, I think it was Thursday morning in Tokyo, that if there's upside CPI, they're going to go 50. And they might go 50 anyway, because she laid out two scenarios, one in which the inflation's temporary and one in which it's not. And they're all losing patience that they can continue to claim it's temporary. And once they determine it's not, which they will if we get two high side CPI prints the next couple months, her argument is we might as well just recalibrate. It could mean 75 for all I know, but she was quite clear it doesn't mean 25 basis points. So if we get like a 0.3 in core CPI, I expect the FOMC rhetoric to turn sharply hawkish in the wake of that. Now, I'm not axed for this number. If it comes 0.1, the market's going to continue to price out September, but we're already only at 11 basis points for September. Even if you get a low 0.2 or a 0.15 on CPI or something, you still have another number next month to contend with. So 11 might go to 5 or 6, but if you get a 0.3, that 11 is going to go to 20 plus. So agnostic about what the CPI report might bring on Wednesday, I want to be betting on a September rate hike given current levels. So we'll see what the data brings. Obviously, the Fed has created a bit of a crapshoot with that, but they really are poised with finger on trigger, maybe for multiple bullets if we get as expected or worse, high side CPI print this week. Good luck out there.